Imagine waking up tomorrow morning, just checking your phone, and seeing exactly 10,000 Australian dollars sitting completely unexpectedly in your bank account.
Just sitting there.
Yeah, just sitting there. Take a second and really think about it. What is your very first instinct? Are you, booking a trip? Are you upgrading your car?
Or does it just instantly stress you out?
Exactly. Does that sudden appearance of capital immediately spark this sort of low-level anxiety about what you're supposed to actually do with it, just to make sure you don't squander the opportunity?
It forces a confrontation with your own financial psychology, right?
Yeah.
Because for most people, capital allocation isn't something they practice daily.
Right.
That sudden injection of liquidity takes this totally abstract, futuristic concept of, wealth building, and suddenly drops it on your lap as an immediate, concrete problem to solve. You are suddenly forced to be a portfolio manager.
And that is the exact tension we are tackling in this deep dive today. We're looking at a really fascinating source document. It's titled Strategic Wealth Building in the Australian Market.
It's a great read.
It really is. And it centers around a very specific, highly relatable case study of two young professionals. So we have Ethan, who is a 24-year-old software developer from Sydney, and Olivia, a 23-year-old finance graduate from Melbourne.
And the brilliance of this text is really how it strips away the institutional intimidation of finance. It frames capital allocation and risk modeling and behavioral economics just as a casual weekend conversation between two peers.
Yeah, which makes it so much more digestible.
Exactly. So Ethan has managed to save that 10,000 Australian dollars. He has successfully navigated the accumulation phase, which is honestly where most people fail.
Right. Getting the money together is the hard part.
But instead of feeling victorious about it, he is completely paralyzed by the deployment phase.
Okay, let's unpack this. Because the way Ethan describes his anxiety about inflation is something anyone with a savings account understands. Keeping cash parked in a basic bank account while inflation just sort of happens in the background.
It's brutal.
It is. It's often described as having a slow leak in your car tire. You look at it today and the number hasn't changed. The tire looks inflated.
Yeah.
But you drive on it for a year and suddenly you're stranded. For our listeners who follow macroeconomics, we know this isn't just a slow leak. It is a structural, guaranteed negative real return.
Mm-hmm.
Ethan is watching his purchasing power actively depreciate, and it terrifies him.
What's fascinating here is the behavioral whiplash that terror induces.
Mm-hmm.
Ethan is sitting in the safest possible asset, cash. But because he recognizes the guaranteed loss of purchasing power, his brain aggressively overcorrects.
He just swings all the way to the other side.
Completely. He abandons risk management entirely. He tells Olivia he's seriously considering taking his entire $10,000 and throwing it into cryptocurrency, hoping for an immediate double.
Because his friends are doing it. He is scrolling through social media, seeing the rocket emojis, the perfectly timed charts, and the highlight reels of people getting rich overnight.
Oh, the FOMO is real.
It's so real. If you are listening to this, you have probably felt that exact same FOMO staring at your own portfolio while someone online brags about a crypto pump. Ethan wants to instantly reinflate the tire, and he's letting social media dictate his risk appetite.
He's falling into the classic trap of confusing an event with a process.
Oh, that's a good way to put it.
Yeah, because social media platforms are algorithmically designed to prioritize the event. The lottery ticket win, the instant gratification. Olivia steps in to dismantle this illusion. She recognizes that Ethan is operating on a totally flawed barbell mentality.
Right, like all or nothing.
Exactly. In his mind, his only two options are the zero-risk mattress of cash or the maximum-risk casino of highly volatile crypto. He completely lacks the vocabulary for the middle ground.
So she delivers a massive reality check, establishing the absolute golden rule of this entire narrative. High returns intrinsically carry high risk, and you never invest money you cannot afford to lose.
It sounds so basic.
It does sound basic, but in a highly speculative market, it is the very first thing people forget.
It is the foundational axiom of risk tolerance. If Ethan needs any portion of that $10,000 to secure his immediate living situation, exposing it to an asset class that routinely experiences 40% drawdowns is practically financial malpractice.
Yeah, it's a disaster waiting to happen.
Olivia is trying to break his illusion of a free lunch here. If an asset can mathematically double in a month, the volatility required to achieve that upside means it can just as easily evaporate to zero. She's shifting him away from the adrenaline of the gamble and toward the actual architecture of genuine wealth building.
And the architecture she proposes is where this narrative goes from, a behavioral critique to an actionable blueprint. Ethan finally asks her the $10,000 question. What exactly would she do with the money?
And she doesn't just give him platitudes about buying low and selling high, right?
No, not at all. She gives him a highly specific structural diversification model.
Because structural diversification is the only proven antidote to the risk Ethan was about to take.
Here's where it gets really interesting. Olivia takes his 10,000 Australian dollars and breaks it into 4 distinct buckets.
Okay.
She tells Ethan to put 20% into a high-interest savings account, 50% goes into ETFs, or exchange-traded funds. Another 20% is carved out specifically for Australian shares, and the final 10% is sidelined purely as emergency cash.
If we connect this to the bigger picture, Olivia is constructing a textbook core satellite portfolio, but she is heavily customizing it for Ethan's immediate psychological needs.
How so?
Well, let's analyze the liquidity profile first. The 10% in emergency cash and the 20% in high-interest savings represent 30% of his total net worth held in zero volatility environments.
But wait, 30% in cash seems incredibly high for a 24-year-old with a long investing horizon.
Mathematically, yes, it introduces a cash drag on his overall returns. But psychologically, it is brilliant.
Okay, why?
That 30% buffer means if Ethan faces a sudden medical bill or loses his job, he doesn't have to liquidate his equity positions during a potential market downturn just to keep the lights on. It protects his investments from his own life emergencies.
Okay. That makes sense. And then we move to the growth engine, right? 50% allocated to ETFs.
Right.
If we were explaining this to a beginner, we might use an analogy. Instead of betting your entire breakfast experience on buying one massive box of cornflakes, which is like a single stock, an ETF is like buying the ultimate variety pack of cereals.
I love that analogy.
Right. You get dozens of different brands. If the cornflakes turn out to be a disaster, your morning isn't ruined because you have plenty of other options. But for anyone who follows markets, the real question isn't what an ETF is. The question is why Olivia uses it to anchor half the portfolio.
She is using the ETF allocation to entirely eliminate idiosyncratic risk.
Break that down for us.
Sure. So if Ethan puts 50% of his money into a single technology company, and that company's leadership makes a catastrophic strategic error, his wealth is decimated. That is idiosyncratic risk. The danger tied to one specific entity.
Right.
By holding a broad ETF, maybe one tracking the top 200 companies, a single bankruptcy barely registers on his returns. He captures the broad upward trajectory of the market, without taking on the localized, uncompensated risk of stock picking.
Which makes the next bucket so fascinating. She just insulated him from single stock risk with the ETF, but then she explicitly allocates 20% to individual Australian shares.
Yes.
Why wouldn't she just put 70% into the broad ETF and completely eliminate the headache of stock picking?
That 20% carve-out speaks specifically to the nuances of the Australian market, which is incredibly top-heavy with financials and materials.
Okay.
By holding direct Australian shares, Olivia is likely targeting the dividend imputation system, franking credits.
The tax benefits.
Exactly. It allows investors to receive tax credits for the corporate tax the company has already paid. It is a highly efficient way to generate yield. She is giving Ethan a controlled satellite bucket to try and generate a little bit of alpha or extra yield, but strictly capping it so it can't derail the core strategy.
It's a very sophisticated setup, but I have to push back on the reality of implementing this.
Before it.
Look at what she is asking Ethan to do. 20% in savings, 50% in ETFs, 20% in individual shares, 10% in a separate emergency fund. That sounds safe on a spreadsheet, but doesn't having all these different buckets make it an absolute nightmare to manage?
You would think so.
For someone already anxious about money, aren't we just introducing massive operational drag and daily stress?
4 accounts definitely sounds like administrative overload. But Olivia is utilizing a behavioral economics concept called mental accounting. By strictly compartmentalizing the money, she is actually simplifying his emotional management. The complexities